If you're an accounting student and you're having trouble remembering what accruals and deferrals are, this is the video for you. My name is Kirsten. I'm a licensed CPA and I'm going to help you with these new definitions. Accruals and deferrals are both types of what are called adjusting entries. So adjusting entries don't have cash involved. Now, in these transactions, what happens is you have a difference between when this transaction hits your income statement and when you receive cash for this exchange. Accruals are when you have an income statement impact before you actually have a cash impact. So for example, right now I am living in this apartment and I am currently incurring all the expenses for running my utilities. So my lights are on, I'm running electricity in the background. Right now I am incurring these utility expenses. But I'm not going to pay for these expenses until the end of the month. So right now I have this accrued expense, I have this utilities expense, and typically the other side of that entry is going to be some type of payable account, like utilities payable. So what's accrued revenue? So if I were to go to work today, and let's say I go to my job and I work 5 hours, that would be accrued revenue because I've earned this revenue, I've earned this money, but I haven't been paid yet. In both of these transactions, both this utilities expense and this revenue that I've earned, I have this income statement impact because I've earned the revenue and I've used some type of resource. I've used these expenses. So the other side of an expense is typically a payable account, and the other side of that accrued revenue is going to be your accounts receivable. Deferrals are the opposite. We are deferring that income statement impact to a later date. So this means that we receive the cash up front, and then later we're going to record the adjustment to our income statement when we finally use the resource or actually earn the revenue. A really good example of a deferred expense is car insurance. Most of us pay our car insurance up front. So if you were to get a 6-month policy and you pay in full today, you've paid for 6 months of prepaid insurance. And as you start to use that insurance, so after 1 month, after 2 months, after 3 months, 4 months, 5 months, 6 months, every single month you're going to record this expense, this insurance expense, as you slowly start to reduce your prepaid insurance. Now, what's deferred revenue? Deferred revenue is when I have been paid upfront in cash for something, but I haven't yet provided those goods or services. So an example of this personally would be if someone paid me through Venmo for, let's say, an hour of accounting tutoring, and if they paid me up front, that revenue is deferred revenue until I actually provide them with the accounting tutoring at a later date. I'm going to do another video on deferred revenue a little bit later, but deferrals are when we are deferring that income statement impact, the expense of the revenue, to sometime after the cash transaction. And accruals mean that we have the income statement impact before we have the cash transaction. Let me know if you have any questions, and I hope this helps.